Hello everyone, and welcome to this example here where we will go through some journal entries required to determine the cash flow hedge reserve in a hedged accounting exercise. So if we have a look at this example, we are told that EXP Limited is the parent entity of the EXP Group. All subsidiaries are wholly owned. The group uses Australian dollars as its presentation currency. On 1 June X9, EXP ordered an item of equipment from a supplier based in the United States. The contract price was $5 million. The contract was due for delivery on the 30th of September in the next year, which is 20YO, and settlement was required on the 30th of November, 20YO. To hedge this transaction, EXP entered into a forward contract on the 1st of June 2009 to purchase $5 million USD on a forward basis on the 30th of November 20YO for 6.875 million Australian dollars. There was no initial cost to enter into the forward contract. The terms of the hedging instrument and the hedged item matched one another, and EXP completed the appropriate hedge documentation for this relationship. EXP designated the forward contract as the hedging instrument in a cash flow hedge relationship. We are provided with a table that shows the cumulative change in value between our hedging item and the hedging instrument. So the change in the value of future cash outflows for the equipment, that's going to be the item that we're trying to hedge. That's going to be the hedged item. And the value of a forward contract is going to be our hedging instrument. So the values as at 1 June 20X9 for both the hedged item and the hedging instrument is 0, because this is when we first started the relationship. And then we are told what the changes in the cumulative value are at both the end of the 30th of June X9 year and the 30th of June YO year. So the question is asking us to calculate the cash flow hedge reserve balance as at these two dates. So our first step in going through this question is to understand what are the key steps in a cash flow hedge accounting relationship. So here, step 1, we need to think about a risk management strategy. Now, this question has made that fairly clear in the sense that we know that EXP has formally designated a cash flow hedge, and they've gone about trying to hedge that risk through using a forward contract. And usually in these questions, you would satisfy step 1. Otherwise, what's going to be the point in trying to assess you on these concepts? Step 2 is to think about the eligible hedged item. So in this case, we talked about EXP purchasing an equipment from a US supplier. Step 3 is to consider an eligible hedging instrument. So in this case, we can see that EXP have used a forward contract in order to hedge out future fluctuations in the exchange rate. And then finally, for step 4, which is going to be our main focus, is to determine hedge effectiveness. And so here we've just provided you with some an idea of what hedge effectiveness is. So it's the extent to which changes in the fair value or cash flows of the hedging instrument is able to offset the changes in the fair value of the hedged item. Now, thinking about hedge effectiveness, we need to consider the economic relationship between the hedged item and the hedging instrument, meaning that these two need to move in an opposite direction in order to be beneficial or be able to hedge against one another. The effect of credit risk, so here hedge effectiveness will not be met if the effect of credit risk dominates the changes in values of this economic relationship. And then also we have to think about a hedge ratio, which really just measures the extent to which the hedged item and the hedging instrument may offset one another. And so in the sense of thinking about hedge effectiveness, there's going to be hedge effectiveness for both a fair value hedge and also hedge effectiveness for a cash flow hedge. Now, the main rule when we need to deal with hedge effectiveness for a cash flow hedge is to use this lower of test. What that simply means is that, and if we think about our table, which is in the question, that illustrates the cumulative change in value between both hedging item and hedging instrument, the lower of test means that the balance in the cash flow hedge reserve at any point in time is only going to be recorded as the lower of, in absolute value terms, of these two amounts. So if we investigate what is the lower of rule, as at the end of 30th of June X9, we can see that the lower of amount is going to be $320,800. If we look at what is going to be the lower of rule for 30th of June 20YO, then that amount is going to be 1,506,000. So these are going to be two numbers that will determine the value of our cash flow hedge reserve. So in this case, in the first year, we record a value of $320,800 in our cash flow hedge reserve, being the lower of amount. And then in the next year, we need to be able to arrive at a balance of $1,506,000, which measures the impact of the lower of rule in the subsequent year, which will mean that we need to recognize a movement of $679,706 into our cash flow hedge reserve. Now, when we then measure the item against our value of the forward contract, then this additional amount will be recognized as the ineffective proportion. And so this ineffective proportion is going to effectively be measured in the statement of profit and loss. And so that is it for this example. I hope you were able to understand a bit more clearly how we calculate the cash flow hedge reserve using the lower of test.